Hi, I'm Peter Rose, founder of Longwood Currency Trading. The probabilities of failure trading Forex are 100%. Why would I say such a stupid thing on a Forex channel? And I've been involved in the Forex market since 2007 and the overall financial markets since the mid to late 1970s. And I did 40 years as a real estate investor. Why would I say that? Well, I say it because that's true. There's a 100% chance you're going to fail. Now we need to qualify that. And at the end of the video, I'm going to describe how you can avoid being part of that 100% and not getting wiped out. You will be part of the 100% of Forex traders that have failed in the trading. But you may not be part of the 90% odds against you of losing 90% of your money very quickly. There's a difference. Failure implies you do something stupid. When you are educated properly and you have the proper rules and you have the proper psychological makeup and view of these markets and the difficulty of trading them, then you're still going to lose. I mean, losing is part of the game. You say you're a 60-40 trader, 6 times you win, 4 times you lose. Hopefully your average winner is greater than your average loser, and so therefore you come out ahead. That's not a failure. The failure is when you don't follow your rules or you don't have rules and you let a bad trade run, or you're trading on high leverage and you don't understand how that can work against you. But there's only a few things that take your account into disastrous conditions that create failure. The 90% who lose 90% of their money in 90 days simply have bad education, they have no idea what they're doing, and they don't know how to respond to the conditions of such a volatile market as the Forex market is. Now, volatility is a good thing if you know what to do with it, but if you didn't have any volatility, you couldn't make any money. Real estate isn't exactly called a volatile market, and yet over a 20-year or 30-year period of time, it is volatile. It just depends on the time frame that you're looking at as to how to judge volatility, right? In my 40-year real estate career, I lost $1 million net worth due to real estate economic collapse. I made the $1 million back each time, but it took me 10 years each time. I mean, you're looking at a very long-term view of a market. But the Forex market, you don't have that long-term view, or you shouldn't. I'm not a big fan of long-term Forex positions. There are too many range-bound country central bank currency boundary conditions that prevent the currency market from going up 5% in perpetuity to the whole world, or going to zero in the other direction. And that has to do with the order flow and the object that's being transferred in the currency position exchange. So failure is a different definition than the odds against you of trading Forex are 90% against you. It's 90%, the traders will lose 90% of their money in a short period of time. Those are the statistical odds over 25,000 currency traders, 43 million transactions. That was the conclusion that a major Forex broker did in analyzing their business. 90% failed in 90 days. and lost 90% of their money. This is a 90-90-90 thing. And those statistics that were out many years ago, this is mid-October of 2024, they're still valid. 90% of the traders are losing 90% of their money in 90 days. Why? Hasn't the education improved? No, it hasn't. Because the people haven't improved. The people that are attracted to Forex, in many cases, don't really understand what Forex is or the purpose of the market. It's just an easy way for them to make money. Some of them get lucky 6 times in a row, and after losing $10,000 accounts 4, 5, or 6 times, they take their $10,000 and in $10,000 or $20,000, and in 6 or 8 lucky hops, they've got a mid-6-figure account, trading at 200 to 1 or 500 to 1. And those are the people that are producing the education for you. Okay? That's like a guy who runs through, I use this example all the time, it's like the guy who runs through a minefield and he gets to the other side. And he thinks he knows how to get through a minefield, so he tells everybody to follow it. And a large statistical sample size of those people that follow him are going to get their asses blown off. All right? That just makes sense. So why? Why do 90% of the traders lose 90% of their money in 90 days? Why was that true 12 years ago, and why is it going to be true 12 years from now? It's because of the education. Well, you would think that the education would get better. In real estate, I was in real estate for 40 years. That education got better as the understanding of the connection between mortgage rates and capitalization values and all that other kind of stuff became better understood in long-term views of some serious financial analysis of that real estate market. Most of the people that were coming into the real estate market when I started had just begun to understand those financial correlations with the overall market that real estate had. There's a binding between how well the economy is doing and how well the real estate does, and they really never made those connections to lay out a trading plan for their real estate development. Today, yeah, there's MBAs working on these real estate issues. But what do we have today? We have a bunch of fools that stumble through a minefield and get to the other side, trading 200 to 500 to 1, and they're the ones that are advising you. Maybe they can do it. Maybe they can continue to do it. Look, if you're trading a $500,000 account, you wouldn't be trading a $500,000 account all up front. You might dribble in $30,000 of that account into a trade. If it goes against you, you're out. You're trading at 200 to 1 or 500 to 1, you lose the $20,000 or $30,000. Well, what do you care? You got $470,000 left. So you throw another 30 against it and you roll out. You throw another 30 against it and boom, you take that 30 and you run it to 6 figures. Now you got a $600,000 account. So it's a dance of diminishing returns with those type of folks. They don't really understand trading. All they're doing is they understand that if they keep pushing the envelope with all of their account, they're ultimately going to lose it. And the reason they're going to lose it is because they're trading at 200 to 500 to 1, but they're not making that connection because that's what they're trying to teach you. Nobody wants to listen to me. I talk to a lot of people through email about consulting fees and stuff, and the reason that my fees are as expensive as they are is because I teach good risk management. I teach it the way that it should be taught. Nobody wants to hear that. They want to hear how they can take their $3,000 and buy a Lambo in 8 months. Nobody's thinking logically out there, and so failure and the 90-90-90 rule are rampant, and they're going to wipe you out. For those of you that are reasonable in how you're viewing the market and what you see as the potential profit of trading in the Forex market, you're having troubles rationalizing what you see that's logically should be possible with the results of the education that's out there that's creating this 90-90-90 conundrum. And if it isn't just 90-90-90, maybe it's just the failure of the trading. I talk with folks all the time through email. They have 2, 3, 4, 5 years of trading experience, and they're not consistent, and they're not making enough money to impact their lives. And the failure becomes a mental thing as opposed to the physical thing of the 90-90-90 statistics. The 90-90-90 statistics are created by bad education. People are consuming bad education, they don't know what they're doing, and they're just stumbling around in the dark without a cane. Failure, you're going to fail. You have a 100% chance of failing, whether your account is $300 or $300,000. But it's the extent of that failure that you need to have good risk management so that you don't wipe yourself out when the failure comes. I was able, when I lost my initial large amount of money, I put $45,000 into my trading account after dumping 2 mini lots 4 years before that. I thought I needed more education. Did 4 more years of education, quote, and put $45,000 into an account, lost $40,000 of that, just like shit through a goose. And I stepped back from it and I said, I'm pretty smart. Why did I lose $40,000? It was because of the education. So I threw all the education out. And I took my background, which was a 33-year career in software engineering, and I looked at the market as a software engineering problem, an application to solve. And in 15 minutes I said, I've been solving the wrong problem. But here's what I've done wrong. Oh, and by the way, here's what I've done right. I took my remaining $5,000 and in 4.5 months I doubled it. Okay, that's my story. Could I have taken that $10,000 then and doubled that? Maybe. Could I have taken that and doubled that? Probably not. And how much would I have lost? I'd have lost all the money that all these guys are losing. But I didn't, because I understood risk management the way that is applicable to the currency market. I had to have really good risk management in real estate in order to come out of that at the end with over $1 million. And I retired. I sold out my real estate. Well, I've been doing it for 40 years. It's time to get out. So I'm trading a 6-figure account, and have been for quite a while. But I failed a couple of years ago drastically, because after that loss and then the regain of the $5,000 and doubling that, I set about growing that account and realized I needed more money to do that, so I put more money into it, grew that, and put a lot more money into it, and had a large account. And I took that large account and I made a big account out of it. And in order to do that, I started out trading 1 to 3 lots and got that successful. Then then I traded 3 to 6 lots, and then I was trading 6 to 8. And in a period of about 8 months, I went from trading the 1-3s to 25 lot size positions. The problem was I hadn't built up enough reserves along there. I had built up enough reserves so that next step up, I could take a bad hit, and doing it like that. But when you start pushing 15, 20, and 25 lot positions, and again, I'm not talking about over leveraged positions. I'm talking about having the proper amount of funding in your bank, not trading it even 100 to 1, but having enough money so that you've got a tremendous amount of buffer for other purposes, not just making a lot of money, but for making a lot of money as your account grows. Kenny Rogers said, you got to know when to hold them and you got to know when to fold them. So I was going through that as I built up those larger lot size positions in the reasonable manner in which I was doing it. However, once I got to that 20, 25 lot position, I made a critical error in my estimation of the failure that you can have at that level. And I wasn't over leveraged. And I lost half of my account. Why? because that's just part of the failure. That's just a loss that went really, really bad. It was one trade. So that gave me some humility, because that was a failure. That was a big failure. So I came into this year humbled, but still having that mindset of how I'm managing those large lot size positions. And I didn't see the event coming again. I didn't think I would have that again. And I dropped another large amount of money. It wasn't six figures by any stretch, but it was big enough to go, wait a minute, I get it. I get it now. Not only do you have to correctly manage the growth from trading from small lot size positions to large lot size positions, but once you have a large lot size position to trade, the rules for that change. And I hadn't figured that out because I hadn't traded large lot size positions before. And all the people that were out there educating trading large lot size positions were doing it 200 to 1 and 500 to 1 and losing massively. But when they hit it right, they would more than make up for that. Those are unique people. You know, there's one architect that can design some massive city skyscraper, but there's thousands of other architects that are making decent livings being architects. You don't have to build this, you know, a large building that they're going to name after you. You don't have to be a Frank Lloyd Wright. And in trading, you don't have to make $1 million. I was trying to make $1 million with the six-figure account because I wanted to duplicate that as to what I was doing in real estate. And the process is really different. The risk management is different in currency trading than it is in real estate. And I'm burdened in my own trading process with that real estate risk management that's ingrained in my DNA. I'm not going to be able to break that. So I have to change that whole large lot size position trading concept and do it differently. It's very simple. And when I follow my rules, I just stumble along and do fine. But there was failure there. You're always going to have losses, but you have to look at the losses as more than losses. It's a failure of you as a person that creates the really big losses, not your trading plan, not breaking your rules. It's your failure. And because we're human, we all have that proclivity toward failure. It's like you got to pee. If you're a human, you're going to have to pee every 4 hours or so. It just, and you got to learn to deal with that. Don't take a 15-hour driving trip if you're not going to be willing to pee in the woods. You have to account for your humanity. You have to account for your psychology. And so therefore, you have to not only accept losses, but you have to accept that there are going to be failures. Let's call the failures the black swans, but they're known black swans. You will hit them because they're known black swans, and because they're known, you will have that. If you haven't had a traffic accident yet, at some point, statistically, you'll probably have some kind of a fender bender, or you'll run back into a light pole or something like that. It's just going to happen. So you wear seat belts and you drive a car that's safe and you stay on the roads and you pay attention and you don't drive drunk. But you're still going to have a failure. Let's mitigate not only the risk that you're taking, which is risk management, but let's mitigate the degree of the loss that you suffer. And instead, that should just be a loss, but not a failure. Because if you don't mitigate both ways, the risk part of it and the size of the loss, then that's a failure. You're the failure. And that's you're not going to solve that. So you have to manage the size of that failure. I told you at the beginning of the video that I'd tell you how to beat that at the end. You got to have a rule at entry that is a short stop that is non-violatable. When that stop is hit, you're gone. Not, well, it'll turn around because it's going to bounce out the 55-period moving average. Or any of that horse shit. Get out. That's all you have to do. Are you going to be able to do that? When you fail to do that, you will have a failing trade. Let's just hope it isn't. It won't take your account, and if it takes your account, it'll take your self-esteem too. Be very careful, because the probabilities of failure trading Forex are 100%. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.